Gross profit is basically its company's efficiency of using its labor. And when I say labor, not necessarily blue collar labor, not we are talking about the factory labor, anyone who's directly involved in delivering a service, right? So how efficiently you are using your direct labor and the supplies, right, in producing goods and services. So it's nothing but your revenue divided by your cost of goods sold. In the setup of say services business, which is healthcare delivery or IT services, you are basically taking into account all your direct expenses to deliver your service to that customer, right? So here basically what we are trying to do, take your revenue, take all your direct expenses. In case of B2B manufacturing setup, all your raw material cost, your labor cost and manpower cost and manufacturing expenses, you remove from your revenue and you get a gross profit. And you have to calculate the margin, you divide it by the revenue. But in case of the services industry, basically you look at all your direct expenses, which is your direct manpower cost that is involved in your service delivery, and all the direct consumable, which is basically the products and the material which is used in delivering those services will get included in your direct expenses, and you get a gross margin or gross profit for your business. How do you improve your gross profits? So there are three ways in which you can do it. One is you improve your net sales. Net sales improvement means if you are giving any discounts, if you are running any schemes, any rebates, you need to work on it. You need to optimize that so that you realize a higher net revenue. Second, if there are any returns in your business, because of the faulty production or anything, so you need to actually reduce your returns so that you can increase your gross net revenues. Third, and which is the most important and most obvious thing, is basically without affecting your margins, without affecting your volumes, if you can increase your price, that will also help you directly increase your gross profits. Other than that, there are other parameters, which is reduction in your cost, right? So if you reduce your consumption of material that is directly used to deliver your service or create your product, it will increase your gross margins. And if there are, in manufacturing setup, if there are any cost with respect to the conversion cost reduction, which is what we talked about, wastage reduction, inventory reduction, right, cycle time reduction, all these things put together gives you improvement in your gross profit. This is my net income derived from, say, my company's primary operations. So you take your gross profits, all other indirect expenses, which is overheads. So expenses incurred in selling your services, expenses incurred in administration, expenses incurred in marketing, and all the other expenses, you basically remove from your gross profit, you get your operating profit, and that operating profit becomes is a true measure of how efficiently your business is basically using all its resources and generating cash for its businesses, right? There are levers, as I said, when you realize and when you benchmark your profitability with the third party, you have to look at, okay, whether my employee expenses is in line with what others have, whether my selling expenses is in line with what others have. Same is with distribution, marketing, administration, and if there are any R&D related expenses and depreciation expenses. So these are all levers that you press to improve your operating profits.